Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by United Wholesale Mortgage.
Does your wholesale lender do this for you? Free customizable marketing materials, online loan tracking for your clients, returns your past clients to you, and complimentary client retention campaigns. Don't you think it's about time you found one that does? Partner with United Wholesale Mortgage and receive these benefits and more.
Hi, welcome to another edition of Master of the Markets. I'm Barry Habib at MBS Highway, and this is created exclusively for Mortgage News Network. You know, we did have a good week for housing news. Once again, last week, we're going to get some more news this week on housing, but we also have the Fed meeting on Wednesday. Very important Fed meeting because we're kind of at a critical juncture here. And what the bond market really would like to see is the Fed hike rates. Yes, I said hike rates. That would actually improve interest rates because we're seeing a little bit of inflationary pressure, and inflation erodes or eats away at the fixed rate return you get over time. So if inflation moves up, it erodes that return more quickly. So if the Fed were to hike rates, it would actually curb inflation. The bond market would like that. And look, I know it's been a long time, 9 years since the last Fed rate hike, but if you think back, bond market and interest rates always responded favorably. Interest rates dropped, bond prices improved, increased when the Fed did hike rates if it was thought that this was curbing inflation. So we could see the same thing. Now, Wednesday's Fed meeting, we're not going to see any Fed action, but we'll look for clues to see what they might do at that September 17th meeting. And it's important because, look, if they don't show any clues about this, I expect interest rates to get worse. If they start to convince the bond market that September 17th, they're going to take action and cut and hike rates, we could actually see mortgage rates improve. So a big day on Wednesday. Now, as I mentioned, housing news, very strong. And that housing data that we have received in the most recent data was important for us because we got existing home sales. That represents 91% of the overall housing market. And that existing home sales figure that we received set an all-time median price of $236,400. Now this is an important thing because it kind of tells us that we've recovered from that housing decline that we've seen. And the levels of appreciation on a year-over-year basis are at 6.5%. Now 6.5% is really good. Now of course I know, look, real estate's regional. All the different areas are going to have different levels. That's why at MBS Highway we have each region around the country that you can take a look at, see what the affordability levels, appreciation levels are, what your anticipated appreciation is, how the job market looks in each level. So it's a great tool to use. Make sure you take advantage of that. But we also want to show you how a level of appreciation, whether it be 6%, 5%, or 4%, how meaningful that is, because customers oftentimes say, okay, 6%, 5%, yeah, how meaningful is that? How am I going to create wealth there? You'd be shocked. And your customers would be shocked. And you know what? Your real estate agents certainly are very, very impressed by how meaningful these levels are if we just could show it to them. So we've created that, and I want to go through that with you. But another point to make with you is that these levels of appreciation, you know, here in the media, they say, well, 5% or 6%, are they sustainable? Can incomes keep up with it? Well, the answer is historically, it's proven that it is sustainable, yes, over hundreds of years. But in addition, when you think about it, the median ratio, front ratio, is 20. That's the median front ratio, which means, let's just say if you have a $1,000 mortgage payment, your income is $5,000. So that $1,000 a month mortgage payment represents a 20 front ratio. Well, let's just say if the monthly payment went up 5% because home prices went up 5%. So that $1,000 a month payment went up 5% or $50 per month. So that $50 per month payment, does that mean you have to make a 5% increase in your monthly income to keep up with a 5% increase in your monthly payment? No, because if your income is $5,000 a month, in order to get $50 increase, your income only has to go up 1%. So in order to keep up with 5% increase in home payment, your income only has to go up 1% per year. So just bear that in mind. The media misses that. And look, there's other factors too. What if interest rates go up? Would that accelerate the increase in monthly payment along with prices? Of course. But I'm just trying to give you a guideline. Now, let's talk about that calculator and show you how you can create some real wealth. So first thing, I put some numbers here. I started off with the median home price in the United States. You can put any number you want in here, certainly. I put closing costs here. Don't include prepaids or escrows. And let's just say, I know that it's been 6.5%. I know the forecast is for 6, but let's just say 5% annual appreciation. And let's take a look at just the first 6 years. You can put any amount that you want. So what does 5% appreciation do after a 6-year period? Well, if you start off with the median home price after 1 year, you get $248,000. 2 years, $260,000, $273,000, $287,000. You know what? After 6 years, that home would sell for $316,000 with 5% appreciation. Now, how much of a return is that for the individual? Well, let's take a look. If you started off paying closing costs, you show up at the closing table, and guess what? You're losing money. You're down $6,000, but after 1 year, with 5% appreciation, you've recovered your closing costs and you're actually up over $5,000. 2 years, $18,000, and it jumps $31,000, $44,000, $59,000. In 6 years, you have an additional $74,000 after closing costs. Boy, think about how hard it is for your customers to save money. What a great way for them to increase their net worth by $74,000. And of course, you can put in any numbers you want up top here. You want to knock down the rate of appreciation. You want to be more conservative, change the percent down payment, whatever it is, you take a look at that. And then how about the return on their investment? If they put 10% down on that home, what's their rate of return? Well, when they first go to closing, they're already upside down. They're down 25% because they've spent that money in closing costs. But guess what? After a year, not only have they recovered it, but they're up 24%. And as you take a look down the line, you know what? In 6 years, they've made 300+% on their investment in this home. So we take a look at this. We know that real estate can be a terrific investment. We know that the media sometimes doesn't get it right, but it's great to be able to articulate these things to our customer, to show them how these things work. And this is a great tool for you to use. If you're an MBS Highway member, of course, get in there and use it. You're probably already using it, and this works great on your mobile device as well. If you're not, click on the link, get a free trial, start showing this to your customers and your real estate agents. I hope you have a great week. We'll talk again next week. Bye-bye.
Today's Master of the Markets was brought to you by United Wholesale Mortgage.
This is Mortgage News Network.